into real esoteric territory, but I still want you to have baseline familiarity with the topics that I'm going to be touching on in this chapter. So what are we going to look at? As per the course outline, these are the specific topics that we want to talk about. And without spending time reading the specifics here, let's move on. The first thing I want to talk about is the concept of compound financial instruments and complex financial instruments. Keep in mind, financial instruments essentially are, they represent for the holder, the right to receive cash or some other asset at favorable terms, and for the issuer, the right to pay or the obligation to deliver cash or some other asset at potentially unfavorable terms. Cash is a financial instrument as well, but since cash is essentially issued by the central bankers, we keep it aside. Common shares, preferred shares, those are financial instruments, as are bonds. Bonds are financial instruments as well. So we will be looking at combinations, if you will, of bonds and equity instruments when we talk about compound financial instruments. That's basically what they are. A compound is made up of two parts. So one part is debt, the other part is equity. So if you merge the two together, you get a compound financial instrument. The most common type is convertible debt. Okay. So you have debt that can be at a later date converted into common shares of the issuer company, right? You can also have complex financial instruments, which is slightly different. So complex financial instruments can be of basically two types there. You can have derivatives. So derivatives are financial instruments whose value is derived from an underlying commodity or item. Right? Deeper look in a bit. We can sometimes have hybrid financial instruments where, for example, a company can issue bonds that come with warrants. Warrants are a type of a derivative financial instrument. So a company could issue bonds with warrants. So that would make it a hybrid between a compound and a complex financial. So what are some examples that you can find of these compound or complex financial instruments? I said convertible debt is the most common. Now, even within convertible debt, we can have one category where the debt may be converted into equity, typically common shares, a specified number of common shares of the issuing company at or after a certain specified date. So if you have something like that, like bonds being issued that can be converted, right? Each bond can be converted into 20 common shares, stuff like that, then from the accounting perspective, we will have an element of liability, the pure liability, that is the bonds that do not have the conversion feature. And then you have the other part, which is the equity portion, and we record that initially as contributed surplus. You remember that from chapter 15, which represents the conversion rights on those debts. Sometimes, though, you can have convertible bonds that may be settled, that may have to be settled later on by issuing an undetermined, a variable number of shares. So compare that to the fixed number of shares. Here, the company, depending on what the company's stock price is at the time of conversion, the company will have to figure out how many shares the company needs to issue. Or the holder may even ask to be paid the value in cash. So that, if you have something like that, it's basically considered to be entirely a liability. You do not recognize any equity component for such type of bonds. Then there is a class called puttable shares. So a company can issue shares that allow the holder, the shareholder, to ask the company, require the company to buy them back. So these are mandatorily, like the buyer can force the company to buy them back. That is considered to be a liability. Although we're talking about shares, because those shares would have to be bought back at the holder's requirement, they are in substance, right? Even though the legal form is shares, which is equity, the substance of this particular financial instrument is that it's no different from a liability and obligation. Companies will often issue preferred shares that are mandatorily redeemable. Again, if the company has to buy back the shares, well, then the preferred shares are supposed to be, well, they are essentially a liability. And the key thing to keep in mind is any kind of dividends that the company pays, if the preferred shares are mandatorily redeemable, right? If the preferred shares themselves are treated as a liability, any dividend paid on those preferred shares will also be considered the same thing as interest expense. So remember the distinction between interest and dividends. Interest is reported on the income statement as an expense, whereas dividends are payments out of retained earnings. They are not reported on the income statement, right? So that distinction between equity and liability matters quite a bit because it will then also determine how we're going to treat any payments made on these financial instruments in the form of interest or dividend and so on. Preferred shares may be contingently redeemable, so the buyback will only happen if certain conditions are met. Again, as long as there is a chance that those conditions will be met, they should be recorded as a liability. Of course, once the conditions are met, then they will be. You can have debt, typically bonds with detachable warrants. Now, warrants are a type of derivatives. They're like options. They allow the holder of the warrants to buy shares of the company, the issuing company, at a fixed price. The warrant holders don't have to buy the shares, but they can. So you have the right, but not the obligation. Well, we do split the issuance proceeds into a liability component and an equity component because the warrants get recorded as contributed surplus. Sometimes companies will issue debt that into perpetuity or for a time frame that is so long that it's unlikely the debt will ever be retired. That debt is recorded as a liability. Now, what about the accounting? Well, if you're dealing with convertible debt, at initial recognition, what we want to do is make sure that you allocate the price for which the debt was issued, the issuance proceeds. You want to split it between the debt component, the liability component, that is, and the equity component. Now, that is a requirement under IFRS. You can't work around that. ASPE has some choices available. ASPE allows the company to basically set the equity portion as $0, right, as nil. So the entire issuance proceeds under ASPE can be allocated to the liability. Regardless, subsequently, the debt component needs to be measured or reported at amortized cost. And if the amount allocated to the liability initially is different from its face amount, remember face value, and then the issuance proceeds would be the PV. If the PV is different from the face value, well, then you would either have a premium or some kind of discount on the bonds, and that has to be amortized in the future. IFRS requires that the company use the effective interest rate method. You may have to calculate what the effective interest rate should be. ASPE permits the use of straight line amortization. And then eventually at derecognition, you can have derecognition either by way of conversion. If the bonds do get converted into common shares, we convert them at book value. Sometimes the bondholders might choose not to convert them. Well, in that case, the debt simply matures and the company has to pay back the money. Any equity component is then transferred into another contributed surplus component. I've got a couple of examples from the textbook. I've modified the examples slightly that I'm going to walk you through here. So here's the file. And here is the link to the file. And what I've done to save time is I've prepared the answers and I'll be revealing them as you go. All right, so starting with an example based on exercise 1610. It's not exactly the same. So if you go try looking up the textbook solution, you will find it may not work out to be the same because I've made changes to the question, okay? So Daisy Inc. here issued $6 million of 5-year 9% convertible bonds on January 1st, 2020 at par less issuance costs of $150,000. Just a few things. 6 million is the face value. 5 years is the term of the bonds. Now, the bonds pay semi-annual interest every June 30th and December 30th. What that means, when you're making 2 interest payments in a year, the number, the N, will not be 5. This is 5 years for the bonds, but every year we make 2 interest payments. So the N will be 5 times 2, N, okay? And each time the interest that the bonds will pay is at 9%, but that 9% is annual, right? So 6 million times 9%, if you do the math, whatever you get, $540,000, well, that represents the annual interest. Since our interest is paid semi-annually, the PMT on the bonds will be half of 540,000, which is $270,000. Just make sure you keep that in mind. Bonds without conversion privileges would have sold at 97. Now, what does that mean? At 97, what does it mean? The bonds were issued at par. Well, at par means the issuance amount was equal to the face value. If this is $6 million of bonds, the company was able to issue the bonds for $6 million. But they also incurred some bond issuance costs. So total issuance proceeds for this company will be $6 million minus the $150,000 of issuance costs. So 6 million minus 150,000, the total amount of cash that the company received is $5,850,000. Now, the company got this much because the company issued convertible bonds. If these bonds had not been convertible, we are told that the bonds without conversion privileges would have sold at 97. That is 97% of the face value. So bonds without the conversion feature would have been sold at 97%. So 97% of 6 million is $5,820,000. Oh, I have to subtract the issuance costs here. I forgot to subtract costs. Minus the issuance costs of 100 and, or let me just say that because the question is not clear here, let's assume that the issuance costs would have been embedded in the 97. I should have been clearer. I don't want to make you folks confused. I don't want to make too many changes here. But typically, even without the conversion rights, there would have been some issuance costs, but I'm not sure that they would have been 150,000. They may have been slightly different. We have not been given the information, so we're just going to go with the bonds would have been simply been issued for this amount, 5,820,000. If that is the case, if we compare the two numbers, we were able to issue the bonds for $5,850,000. If the bonds were not convertible, they would have been sold for $5,820,000. So the difference between the two, the extra $30,000 that we got, is on account of the conversion privilege. So when we record the journal entry for the issuance of the bonds, what we must do is we're going to record the fact that we've got cash of 5,850,000. So you want to debit cash 5,850,000. You will credit the bonds payable liability for 5,820,000. That's the amount that the bonds were capable of being issued at if they did not have the conversion feature. So credit the bonds payable liability for the pure amount of the liability, the pure debt value, right? Without any conversion feature. And the difference, $30,000, gets recorded as an equity account, contributed surplus that is related to conversion rights. Contributed surplus, conversion rights, credit for $30,000. Does that make sense? All right. Once this is done, subsequently, the bonds will be recorded or accounted for at amortized cost. Now, keep in mind, when these bonds mature, the company will have to pay back $6 million. The company's only recorded the bonds payable liability at 5,820,000. So there is a difference. And that difference represents the bond discount. Now, the bond discount needs to be amortized over the time to maturity of these bonds. And that has to be done as per IFRS under the effective interest rate. Now, in this question, the effective rate isn't given to us. We have to determine it, right? So how do we do it? We got to calculate the rate. So we know that the face amount of these bonds is $6 million. And the company is going to have to pay the $6 million. So I put that in as a negative. Every 6 months, the company is going to pay $270,000, right? 6 million times 9% divided by 2 gives you $270,000. The number of times the company is going to pay the $270,000 is 5 years times 2 payments each year. That's 10. So N is 10. And the company has recorded these bonds right now for 5,820,000. So that's the PV, right? That's the present value of this bond liability. So this works if the I by Y, the interest rate is, and this you need to make sure that you're using as many decimal places as possible here. So the ones that are visible on the screen is 4.88637%. I would say do not round this particular calculation. Let it be whatever it is in Excel. If you're like, I don't recommend using the thing with you, right, showing your workings on Excel is the marker, like me or whoever is marking your papers, even for the CPA, should be able to see how you got the numbers. If you did your work on a calculator, then without any kind of audit trail as to how you arrived at your number, if your answer is wrong, you basically don't get any marks. Okay, so a lot of times people think, oh, but I should be given process mark. But yeah, you need to show the bloody process, right? So it is better to show all your work. Use the functions in Excel CPA, you are going to be using computers. You folks have most likely become pros already, under the circumstances with COVID and so on, at using computers. And if you haven't till now, um, if I don't know how things are going to play out, if you take advanced financial accounting next semester and say, I happen to be your instructor again, I can guarantee you, even if it's an in-person class, I will make you write the exam using Excel. You need to be comfortable with Excel, right? So one of the things that, in case you want to become an accountant, doesn't matter if you want to be a CPA or not, you want to work in the field of accounting, you really have to be comfortable with spreadsheets. So something that you need to find time if you are not already comfortable doing so. There's lots of tutorials on YouTube that you can watch. Something that I recommend is, if at all it's possible, try to get yourself a second screen if you are working from home. Even if you're using a laptop, right? Have a second screen that you can use. Uh, maybe there's cheap ones available on Kijiji or whatever. It really, really, really makes a huge difference when you're trying to, especially when you're working with numbers, or when you're trying to do practice problems, you'll find having two screens is a huge plus. All right. So these are things that really will give you a whole lot of more advantage than just spending hours and end uh, just reading the book or stuff. You got to do practice, and when you're practicing, make sure you practice using Excel. And there is always the temptation of using a template, right? Oh, the instructor prepared the answer in a template, I'll just copy paste the template, change the numbers. The thing is, it's not your work, so you're not really learning a whole lot. You would be just be trying to reverse engineer answers, and all that has to happen on an exam is a minor tweak, right? That change, make one subtle change, and if you aren't able to catch it, that template doesn't. So make sure that when you're doing practice, you prepare the templates from scratch, do the work from scratch. It takes time, it's not easy, right? Exams won't be an easy affair. And why am I mentioning exams? Because I think a little birdie reminds me that next week we are writing a midterm. Am I mistaken? That is correct. So I will expand a little bit more on the midterm later tonight. Okay, just remind me in case I forget. So over here, calculating this effective interest rate, is everybody okay how we got it? All right. Now, once you've figured out, now this particular rate, the 4.88637% that is shown up, is a semi-annual rate, right? Because the bonds pay interest semi-annually. This rate is a semi-annual rate. Okay, if I asked you what is the effective rate, your answer wouldn't really be this. That's the semi-annual rate. The annual rate is twice this, right? The annual rate is 9.7727, whatever that is. But you know what? For preparing the amortization schedule, we just need the 4.88, that rate. And so just another reminder, how do we prepare a bond amortization schedule? Because you will on the midterm be preparing one, right? So you will start with 5,820,000, right? That's your starting point, 5,820,000. And you got to keep in mind that this company is going to make 10 payments of $270,000 each. So in the cash column, you'll have $270,000 in each of the years. Now, the interest amount, the interest expense for this company, will be calculated using this rate, the 4.88637, whatever that percent is, but it's going to be multiplied by the balance of the bond liability for each interest payment date. That number is going to change, and it is going to increase with every payment, right? So if you calculate it for the first time, 4.88637, this percentage times 5,820,000, if I multiply those two, the amount that I get for interest expense is 284,387. Now recall the bonds were issued at lower, less than their face amount. So what needs to happen is that the bond liability must go up to $6 million. Got to bring it up. To bring the liability up, what must happen is my amortization number can't be positive, because if I have positive amortization, my bond liability will decrease by it because I'm going to be subtracting the amortization. This number is actually, uh, whatever is the opposite of amortization, right? So a possible term could be accretion, right? That is what is used for asset retirement obligations, if you remember. So we could think of it as accretion, but I'm just using the word amortization in a very generic term sense here. And the amortization is nothing but the cash minus the interest. So from the cash, if you subtract the interest, you see that the cash number is lower. $270,000 is less than the interest of 284 and change. The difference between the two, right? Because the cash payment is less than the interest expense, we're going to be falling short by 14,387. This amount that we've fallen short, the amount that we have not paid enough in interest to the bondholders. The bondholders are not going to forgive or forget. They're simply going to add the amount that we did not yet pay to what we owe to them. So what happens is the bond liability goes up. Now, mechanically, if you think about it, you're going to subtract a negative number. When you subtract a negative number, remember minus of a minus turns into a plus, right? Grade school algebra stuff. So 5,820,000 minus a negative 14,387 actually means I end up adding 14,387 to the bond liability, right? Goes up a bit. And that continues in the future. So next time I calculate the interest, it's going to be 4.88637 times this guy. Now, a few Excel tips and tricks help you save time. And if you notice, what I did is, if you just click on what I've done, notice I linked the amount of payment to this PMT number. The number here I had input as negative, but I want my cash to show up as positive. So one of the hacks that I used was I put in a negative symbol, right? So negative minus of the minus 270,000 turns it into a positive. Then notice the use of these dollar symbols. So dollar symbols are used for what's called a fixed referencing, right? Not a dynamic reference. So once I have, now how do I get the dollars? I can type in the dollars if I want, or if I'm using a Windows PC, if I'm using Excel on a Windows computer, all I have to do is press F4, function 4, and it automatically, puts in the appropriate dollar symbols. The reason why I do that is after that, all I need to do is just click at the lower right hand edge here. You might be able to see that that little plus symbol showing. And if I just drag down, the entire thing is copied, right? My entire formula is copied. If I did not have, right, if I had not made the reference, right? If I had just had not put the dollar symbols and then tried to copy, notice that I'm going to run into trouble, right? It's meaningless. The reason for that is that whereas this cell is linking, and how can I see what I'm linking to? You can press F2, or you can click in the formula bar. So you'll see this first one, cell J17 is linking to cell J12 there, but the one beneath it is linking to cell J13, which doesn't have anything. So these are things that, oftentimes we as instructors say, oh yeah, you should know, that is pretty basic Excel. But I have learned over the years that not everyone uses Excel all the times. And sometimes, forgive me for saying, we think of Excel just as a cousin of Word, that everything has to be typed in. And if you're doing that, then it's really tough. It's really tough to do the math that's necessary for a course like this and be able to do well. And that's where sometimes anxiety creeps in and self-doubt creeps in. All right. So the great news is we have once a week class. If you just pretend that you're taking two classes a week, one class on Thursday night, you kind of spend on this, and maybe find another weeknight. And if you are a little bit unsure or unfamiliar with Excel, use that time to learn more Excel, and you will come out that much stronger and more um, confident in your abilities. Anyhow, that was my public service announcement for the night. So next interest expense is 285,090. The amount of amortization is a little bit more, you can see. And all of this keeps going until you hit the last payment when you'll be at $6 million. So not going to spend too much time walking you through every row. That's basically the logic of the calculation. Why did I do this row though? Why did I show you this bond amortization schedule? Well, it's needed for Part B to record interest expense at December 31st, 2020. We've been asked to record the interest expense, the second interest payment, right? They didn't ask for the first one. They asked specifically, give us the interest expense entry for December 31st, 2020. So you highlight that row and you're saying, okay, cash is 270. This company will be paying cash. So credit cash, 270,000. Why is it paying the cash? Well, because it has incurred interest. Well, how much is the interest? 285,090. So debit interest expense, 285,090. But wait a minute, 285,090. The interest is 285, and the company's only paid 270. What happens to the difference? Well, the difference gets added to the bond liability. Remember, liabilities are credits. If you want to increase a liability, you need to credit the liability. So that's the missing credit. So herein is your journal entry. Debit interest expense, 285,090. Credit the cash, 270. The difference, credit bonds payable. So Tony's asking, as for interest, do we need instead 5,820,000? So Tony, that's what I was explaining there. The interest rate that's calculated here is the semi-annual rate, right? So it's already
yeah,
reflecting half a year's.
Okay, thank you. I figured it out too, but yeah, thank you.
Yeah. Now, Part C says they did a conversion. All right. So the company on April 1st, 2021, converted 1.5 million of these bonds into 30,000 common shares. So 1.5 million is the face value of the bonds that were converted into common shares. Accrued interest was paid in cash at the time of conversion. Of course, like if you're converting on April 1st and interest is paid every June 30th and December 31st, the bondholders are going to say, oh, okay, you're converting into common shares. That's great. But what about the fact that we are eligible to receive interest at least from January 1st up to March 31st? So the company also paid accrued interest. So you've got to do a little bit of math here. First of all, if you look at what's the proportion of the bonds that we are converting, total face value of the bonds was 6 million, and we are converting 1.5 million. So that's pretty easy. 1.5 million out of 6 million. We're talking about 25% of the bonds have been converted. So that's a fairly simple calculation, and that helps us do the math a little bit more efficiently. So we are converting 25% of the bond. Now, before we convert the bonds, we need to make sure we update the interest expense on the bond. So let's see if you folks remember this. I remember Tony asked me the question as well. So interest. We are converting the bonds on April 1st, 2021. If I'm looking at this bond amortization schedule, the April 1st date falls in between these two dates, December 31st, 2020 and June 30th, 2021. So between these two dates. Now, this one, the December 31st, 2020, has already happened because if you're sitting on April 1st of 2021, December 31st, 2020 is history. That means that's gone. We don't want to look up those numbers for the interest. So for the interest calculation, we must look at the next row. Now, the next row is for June 30th. Okay. So from December 31st, 2020 to June 30th, 2021, the total amount of interest expense will have been 285,827. Okay, 285,827. Now that's for all of the bonds and for a full 6 months. We're doing the conversion on April 1st, which is right smack in the middle, right? 3 months since December 31st, 2020. So you got to make sure that you orientate yourself appropriately, accordingly. The 287,827 represent interest on all the bonds. We're not converting all the bonds. We're only converting 25%. We got to prorate 25%. Now, if you do prorate 25%, 285,827, and you times that by 25%, the number that you get is fine, but that will still be for the full 6-month period from January 1st, 2021 to June 30th, 2021. We're doing the conversion on April 1st, which means we have to do a further prorating for 3 months, right? Half the period, 3 months out of 6. So the interest expense, it's a good idea to calculate it separately. The total amount of interest expense would have been 285,827. We're converting 25% of the bond, so that's times 25%. And since we're doing the conversion exactly 3 months after the last interest payment date, and interest is being paid once every 6 months, the times 3/6 allows us to prorate for the length of time that has transpired. Now, if let's say the conversion happened on March 1st, we would have prorated for 2 months, right? 2 out of 6. If the conversion happened on May 1st, we would have taken 4 out of 6, those kinds of things. So this just keep in mind that interest is being paid once every 6 months, and we have to pick up the number of months that have expired since the last time the interest was paid. The last time interest was paid was December 31st. Okay. So it's not hard, but you got to be careful. Like if you don't pay attention, you could end up getting it wrong. Okay. So just make sure that you're clued in on this. So total amount of interest expense to be recorded works out to 35,728. Now, how much cash do we pay? For the cash part, remember every 6 months we pay $270,000. That's on all the bonds. We're converting 25%. So prorate for 25. And then also the fact that we are doing the conversion on April 1st, prorate for 3 months, just like you did for the interest expense, 270,000 times 25% times 3/6. That gives us 33,750. So the accrued interest that we actually pay them in cash is 33,750. Once again, the numbers don't match up, so there's going to be some amortization involved. So debit the interest expense for 35,728, credit cash for 33,750, and the difference, you're going to credit the bonds payable liability for 1,978. So this is specifically the amortization of the bond discount on the bonds that we are converting, right? So this 1,978 relates only to the bonds that are getting converted, okay? So record the entry for the interest. Then figure out what is the book value of the bonds that are getting converted. Now, that one's a bit tricky as well, because what is the amount that I'm going to debit to the bonds payable liability? But once, because when we convert them, the bonds payable liability needs to go down. For that, you got to debit the bonds payable. Now, what's the amount that I'm going to do? For that, keep in mind the book value, right? So this table, this table is pretty helpful. Now, we're doing the math on April 1st. Now think about book value. The book value of the bonds only gets changed every interest payment date. Yeah, you start with the 5,820,000. The first time you made an interest payment, the book value changed. It went up a wee bit. Then it went up a wee bit more. Then it went up a little bit more, or it's supposed to go up a little bit more, right? But so when we talk about what's the book value of the bonds, the book value will, your reference frame is going to be this bond amortization schedule. Now, if I'm asking you the question, what's the book value on April 1st of 2021? It would be incorrect to look at June 30th. For the interest expense, we picked up the number from June 30th, 2021. Why? Because we said the 285,090, the interest that was paid on December 31st, that's history, right? That's for a previous period. So when we accrue the interest on the bonds to the date of conversion, we pick the amount with reference to this row, the June 30th, 2021. When I ask you what's the book value, the last time you updated the bond liability was on December 31st. The June 30th date entry has not yet happened. So when I ask you what's the book value of the bonds, your answer is, well, as of December 31st, 2020, the book value of all the bonds was 5,849,477. That's the last time we ever did anything to that bond liability, right? So that's my reference point for the bond liability, the book value. Now I'm converting 25% of that. So calculate 25% of 5,849,000. Okay. Now you do that math, 5,849,000, you calculate 25%. And then keep in mind that when I recorded this entry for interest, I further credited $1,978 to the bonds payable. And this one I said was specifically to the bonds that are getting converted. So what should happen when you credit the bond payable liability, your liability should go up, all right? So when you are calculating the book value of the bonds being converted, you multiply 25% of the 5,849,000. And then keep in mind the $1,978 that you credited the bond payable liability, you need to add, okay? So 25% of that 584 plus the 1,978, the total works out to 1,464,347. Okay, that's what it amounts to. So if you're converting these bonds, it means those bonds no longer should exist on our books because they have been converted into equity. So the bonds payable liability needs to be wiped out. You want to debit the bonds payable for 1,464,347. All right. Now you do that part. Then you say, okay, I also need to remember that when initially these bonds had been issued, we had recorded $30,000 towards contributed surplus. Now that $30,000, remember, contributed surplus is any extra payments received from shareholders, right? Or these would have been potential shareholders. So $30,000 was the contributed surplus which recorded for conversion rights on all of the bonds, the $6 million face value of the bonds. Out of that $6 million face value of the bonds, 1/4, like 25%, has now been converted. So out of $30,000, 25%, right? 1/4 of $30,000 or $7,500 of contributed surplus also needs to be debited out because that much of bonds has been converted, right? So flip that out. Debit contributed surplus conversion rights, 25% of $30,000, that's 7,500. So debit that along with the bonds payable, and the total of these two, right? Total value of these two is what you credit for common shares. This is called the book value method. So if you do practice questions from the textbook, you'll find the textbook will say the company uses the book value method. Well, that's the only method that IFRS allows you to use. This is what you do. You will get rid of the bonds at their book value, get rid of the contributed surplus, proportionate to the amount of bonds that were converted, and credit common shares for the total. Does that make sense? The math might be a little complicated, but conceptually we need to be a little bit sure of the concepts. The math, we can do it. And so, Rachel, fair point, right? I mean, I wish accounting were I wish this course were called an appreciation of accounting, right? Then I would, as a magician or something, right? As a performer, I would do the math, and people can sit back and relax. But accounting is like a gerund, right? It's like swimming, which I can't do, right? So if you put me in the deep end of the pool, I'll sink. And that's quite similar to a lot of what a lot of people might feel about accounting, right? So when I see it happen, it looks very easy. When I try to do it, it's a little bit challenging. So you got to do practice, right? That's the only thing to do. Yeah, it gets it gets a little bit easier, but if you keep up the curiosity as well, even when you're doing the practice, Kyle, if you kind of try to talk to yourself. I don't want you to seem like you're a mad person, right? Like you don't want your family members to kind of say, this person has gone berserk. But if you're able to try to reason it out, like why am I like what am I doing? And then why am I doing this? Like if you keep having that little inner dialogue with your mind, you'll find epiphanies will come. There will be deeper grooves, deeper etches in your brain. And if you still can't wrap your head around it, that just tells you, listen, I need to maybe reach out to Harjinder and see if I can, if he can explain it a little bit differently, because I obviously didn't get it the first time. And like, of course, we are limited by the amount of time we have and so on. There's a lot of learning you can do later. But to the extent that we can have those conversations, you'll find it will make sense, right? Once it makes sense, you're not going to forget it. All right. Seem to be in a preachy mood today, and I'm mindful that I've used up an entire hour, and I'm still on the first example. All right. So the remainder of the bonds were not converted. So prepare the entries to record the maturity and repayment of the remainder of the bonds on December 31st, 2020. So on December 31st, 2024, the total amount of the bonds that would have matured if they were not converted was 6 million. Now, of course, out of 6 million, 25% have been converted. So we only have 4.5 million remaining. So 4.5 million is the amount of bonds payable liability that remains. So you want to debit the bonds payable liability, 4.5 million. Now I'm not showing the journal entry to record the interest. You can if you want to do that. I'm just showing you the entry for the repayment. So debit the bonds payable, debit credit cash for $4.5 million. And since we didn't convert these remainder of the bonds, the remaining balance in contributed surplus. So remember, original amount was 30,000. Out of that, we had used up 7,500 when we recorded the entry for the conversion of 25% of the bonds. The remaining 75%, that gets closed out against another contributed surplus account, except that you add the word expired, right? So debit contributed surplus conversion rights. So think of this as a live fuse bomb or something, and then the expired conversion rights is it's not going to blow up or anything. It's gonna stay parked into equity. And the only reason you can use the contributed surplus is if the company ever decides to pay out a liquidating dividend. Otherwise, it just stays in equity. So Mehak in part C, yes, so that is Jan, Feb, and March. Since we are doing the conversion on April 1st, it's Jan, Feb, March. Yeah. And only on the bonds that are getting converted, right? Not the remainder. All right. Looking at another example, exercise 1616. Again, I've adapted it a little bit. So what I've got here is on September 1st of 2020, Oxford Corp sold at 102. So 102 is with reference to the face value. 102 means 102%, the 2% premium on top of the face amount, plus accrued interest. 5,200 of its $1,000 face value, 10-year, 9% non-convertible bonds with detachable stock warrants. So this time around, these bonds are not convertible, but they come with warrants. And warrants are like options. They allow the holder to buy a certain number of shares of the issuing company at a fixed price if they want. And if they don't want, that's okay. And so these warrants are derivative instruments, and they're traded, right? So they're traded on the stock exchanges, just like shares are, and their value is derived from the value of the common shares. Okay, so this would make it a complex financial instrument where you have the bond element, the pure liability, and then you have the equity element, which is essentially the warrants, right? Being a derivative, but it's equity because the warrants can be exercised to buy shares. So kind of a cousin of the conversion rights part. So each bond carried two detachable warrants. Each warrant was for one common share at a specified option price of $10 a share. Shortly after issuance, the warrants were selling for $5 each. So the fact that the warrants were selling for $5 tells you that was their fair value shortly after being issued, so that you can use that as an approximation of what the fair value of each warrant at the time of issuance. Assume that the bonds without the warrants could have been issued at par plus accrued interest at 102. If the bonds didn't have the detachable warrants, we could have issued them at par. Interest is payable on December 1st and June 1st. And notice the companies issued the bonds on September 1st. So, which is not really either of the two dates on which the company actually pays. Now, September 1st is the date that follows June 1st. What happens when a company issues bonds between interest payment dates is that the company, see, per the as per the contract, the bond indenture, the company will have to pay semi-annual interest on its bonds at the specified bond rate of 9%. So it'll take the face value. Face value here will be 5,200 bonds times 1,000. So that's a total of 5.2 million. And the company is going to pay semi-annual interest at 9%, right? So you're going to calculate 9% of 5.2 million and then have it. And that's going to give you a certain amount, right? To 260,000 or whatever that is. No, less than 260, 36, 234, right? So 234,000 will be the semi-annual interest. And even though the bonds are issued on September 1st, the interest payment, the first interest payment is going to happen on December 1st, right? And the company will have to pay $234,000 of coupon interest to the bondholders. Now, nobody's stupid. Nobody's like, they don't hassle, they don't haggle. They say, okay, right? I mean, we had the bond issuance midway. All right. So the people that buy these bonds, they pay upfront to the company the coupon interest from June 1st up to September 1st. And so this is like, every 6 months, just to make sense of it, let's say if I was to pay $100 interest, right, for every 6 months, and the bond contract says, come December 1st, I'll have to pay you $100 interest. But I didn't borrow the money 6 months ago. I only borrowed it 3 months ago. Now, just to make the bond indenture keep it going, what we could do is, like, you could give me the money that I'm borrowing from you and also give me an extra $50 and say, okay, I'm giving you an extra $50 now. When it's December 1st, you only need to have paid me $50, but the bond indenture says you must pay 100. Pay me back this 50 along with it. So that is kind of like, and I don't know if I made it sound more complicated here, but essentially what the people that buy the bonds do is they pay upfront a certain amount of the coupon interest for the time that has elapsed already, right? How much time has elapsed from June 1st, which would have technically been the last interest payment date, up to September 1st. So that length of time, they calculate how much the coupon interest would have been, and they prepay that amount over to the issuer. So Oxford, when they sold these bonds, they actually got the coupon interest from June 1st, 2020 up to September 1st, 2020. And what Oxford is going to do on December 1st is just pay back the cash that it got, right? It's just an in and out journal entry. We didn't do this in chapter 14. I didn't complicate things at that point, but I think here for this short example, we can live with it, right? I usually don't make these complications for exam questions. I try to stay clear with it. This is just, it's just satisfying arithmetic curiosity. So anyhow, how do we do, what exactly are we supposed to do here? Now, the question is only asking us to record the issuance of the bonds. And it's saying under both options available under ASPE. So there are two options available under ASPE. What about IFRS? Remember IFRS, no options. So what do we do under IFRS? Well, under IFRS, we need to allocate whatever issuance proceeds we have between the bonds, which is the liability, and the warrants, which is the equity portion, based on relative values of the bonds, just pure bonds, i.e. without any warrants, and the fair value. So what does that mean? The issuance proceeds, first of all. The company sold 5,200 bonds. Each bond has a face value of $1,000 at 102. So issuance proceeds is 5.2 million times 102%, 5,304,000. That's how much the company was able to issue these bonds for. And not just that, the company also got accrued interest from June 1st to September 1st. So June, July, August, 3 months. So 3-month accrued interest at what? 9% on the face value. So 9% of face value for 3 months. You do that math, it works out to $117,000 of accrued interest on top. So total cash received is 5,304,000 plus 117,000 works out to 5,421,000. Park that. That's how much cash we got. So as part of the journal entry, we will debit cash 5,421,000. Okay. Debit cash, 5,421,000. Now, the issuance proceeds was 5,304,000. That has to be under IFRS allocated. So we need to allocate our issuance proceeds of, 5,304,000. This 5,304,000 has to be allocated, I split between bonds and warrants. Now, how are we going to do that? IFRS says use the fair value of the bonds without warrants. So assume that the bonds without the warrants could have been issued at par. So we could have issued the bonds without warrants at par. And what's par? 5.2 million. So that is the fair value of the bonds. Now, I could have made this more complicated by giving you market interest rates, and then you'd have to calculate PV of the cash flows, right? So I didn't do it. I'm just, using a simplified expression, but it is entirely possible to make this question much, much more complicated, right? So please be appreciative of that. But we're just focusing on the concept here. So I'm not intentionally making it harder than as. So bonds without warrants could have been issued for 5.2 mil. What about the warrants? Well, every bond, how many bonds? 5,200 bonds. Every bond comes with two warrants, two detachable warrants. So 5,200 bonds times two, that's the total number of warrants. And the warrants were selling for $5 each. So fair value of each warrant, $5. So 5,200 bonds multiplied by 2 to get the number of warrants, multiplied by 5 to get the fair value of the warrants. That, my friends, works out to a total of $52,000. So the total fair value of these two instruments, right, the bonds without warrants and the fair value of the warrants, $5,250,000. So using the relative fair value, right? So if the total amount is 5,252,000, and out of that the bonds are 5.2 mil, if this 5,252,000 was 100%, how much is the bonds? So 5.2 million divided by 5,252,000. If I do the math, it works out to 99.01%, which means the warrants are 0.99%. So if I have to allocate 5,304,000, 99.01% of 5,304,000, that's going to give me 5,251,485. So just did some arithmetic, and the rest is the amount allocated to the warrants. Does this calculation make sense here? We take the individual fair values and then split the issuance proceeds based on those individual fair values. Everything okay? All right, so the journal entry, I credit the bonds payable liability for this 5,251,000, and I credit contributed surplus stock warrants for the 52,515. And then remember, we had received 117,000 extra as the interest, accrued interest from June 1st to September 1st. That's not for us to keep. That's just going to be an in and out entry essentially. So as of September 1st, the company records an interest payable of $117,000. right? So this option is, well, not an option. This is what you got to do under IFRS, but this is one of the options that you can use under ASPE. ASPE says you can do what IFRS tells you to do, or what you can also do is say the equity portion, right? The amount for the warrants, you can set that to be zero. You can say that's not nil. My equity part is nil, which then means you don't have to worry about any split. The entire issuance proceeds can be recorded as the bond payable liability. So under option 2, debit cash for how much cash you got, 5,421,000. Out of that, 5,304,000 record as bonds payable, and the rest is interest payable. Now, of course, if we are talking about an exam, what is the likelihood of me saying, oh, the company follows ASPE and chooses to set the equity component as nil? You know what? I could go on a lark and do just that and have a quiet chuckle, but mostly people, try to follow what is normally done by textbook authors and all that, and you're likely going to see, you're going to be asked that if you're given IFRS, you can't make that choice. So Lisa's hand is up. Yes, Lisa, go ahead.
So on December 1st, do we have to pay the 117,000 plus whatever interest is accrued from September to December?
Well, it would be 234,000, right? So that's the every 6 months. So let's see, we have 5,200 bonds, $1,000 is the face value. So total face value is 5.2 mil. The company pays 9% interest every 6 months. So that's 234, right? So the company will have to pay a total of 234,000. Now that 234,000, the cash that the company pays, half of it will represent the interest that it has pre-received, right? This interest payable that they have recorded, and the other half will represent the coupon payment from September 1st to December 1st.
Okay, thank you.
Yeah. Tony?
Yeah, I have a quick question here regarding for the interest payable. So I just wondered the way that you calculate it from June 1st, but I'm thinking this company issued their bonds in September. Do we instead count September, October, November, and December instead?
So the interest payable it's an artifact of the question. The question says the company issues these bonds along with accrued interest. So the accrued interest that they're talking about, it represents the interest up to September 1st, 2020 from what would have been. So the bonds, if their interest payment dates are June 30th or June 1st and December 1st, the bonds must have an issuance date of either June 1st or December 1st. Now, if the bonds are actually being issued on September 1st, it would make sense that the bonds are dated to have been issued on June 1st. Okay, so that's more of a, so this is an artifact of the olden times when bonds were physically printed, right? So when you printed the bonds, you had to state what is the date these bonds are issued. And if the interest payment date says June 1st and September 1st, then, and we are making the issuing the bonds on September 1st, the most likely, so you would not pre-issue the bonds, right? You will not say, oh, the bond date is December 1st, 2020, but we would like to issue it on September 1st. Nobody's going to sit and listen to you there, right? Why would people give you free money? So it is usually on the other side, you say, oh, these bonds are dated to have been issued on June 1st, 2020. Actual date of issuance is September 1st. To make that happen, and that used to be because again, this was pre-internet times and so on. Things in finance even used to move very slow. So at that time, what used to happen is that the people that bought the bonds, if the bond issuance occurred between interest payment dates, the people that bought the bonds had to prepay the company, the issuing company, the accrued interest up to that date, and the company would just return that money back to them on the next interest.
Okay, I think that makes sense. Okay, thank you.
A lot of this is like novelty now. This wouldn't happen in today's day and age, right? This because everything is digital and so on. Computers can do the math at the background. You won't even have to worry about there being an actual physical bond date because nobody's printing the bonds anymore, right? It's all digital. So this is the reason why I didn't even do a demonstration question in chapter 14 when we were learning about bonds. I didn't do a bond issuance between interest payment dates because it doesn't make sense. It doesn't happen anymore, right? This is something from way back. So maybe there would be a novel that you read in which some accounting shenanigans are taking place and you'd say, oh yeah, I learned about bonds being issued in interest payment dates. Otherwise, it's just some stupid debits and credits happening here. All right, my friends, that was fairly exhausting, but we were at 1/4 of the lesson. So picking up a little bit of pace, looking at the next bit of topic. So derivatives. So derivatives are complex financial instruments in the sense that they are um, the value of a derivative is linked to an underlying commodity and or an underlying instrument. Um, and the most common example of a derivative that you may have heard of might be options, option trading, etc. If you maybe have heard of that. Warrants, we just saw that's an example. Warrants are kind of like options. And then you've got something called forward contracts and futures contracts. So maybe you have come across the term futures, crude oil futures are trading. So, with a June expiry, July expiry, et cetera, et cetera. Those are some fairly common examples of derivatives. Now, there are three characteristics that we have to keep in mind that for a derivative, the value of the derivative is linked to something that underlies it. So if I talk about crude oil futures contracts, the value of the crude oil futures contracts would be linked to the value of crude oil. So as crude oil prices, spot prices change, the futures will reflect some of those changes, right? The future prices will reflect some of those changes, but there's also other things into play, right? Expectations into play as well. Typically, derivatives from an investor's point of view need much less of investment rather than actually investing in the underlying asset. So I mean, you can buy call options, for example, to buy 1,000 shares of a company whose actual stock price might be $20. So rather than buying 1,000 shares of the company for $20 each and pay $20,000, you can buy a call option for 1,000 shares. The amount, depending on what the strike price is that you've chosen, it may be a very, very, very small, insignificant amount. Might be just, $100, $150, something like that. Not a lot, right? Not a lot of money. So they usually require very little initial investment. And in some cases, for the forward contract, you might not even need any investment upfront. And they are settled at a future date. In most cases, the date is specified. It could be end of a calendar month. That tends to be the case for futures, but for forward contracts, it could be some other date as well. Now, usually companies will use derivatives to manage certain risks. So if I'm a farmer and I'm concerned about what price I would get for my canola, seeds, I might sell futures, or I might sign a forward contract. If I am, you know, an investor who believes that a certain company's stock price will go up in the future, uh, well, then I might be engaging in what's called speculation. And rather than purchasing, buying, and holding the shares, I might say, okay, right now the company's stock is trading at $20. I think it can go much higher than $25. So I could buy call options for $23 or $24 at a very, very insignificant initial investment. And if my bet plays out, I would make money on whatever is the excess above the exercise price. So companies, depending on their outlook, they'll have treasury departments that engage in active options trading. They can make a lot of money, they can lose a lot of money as well. But usually these kinds of derivatives are used by companies for managing risk. Now, how do we account for these derivatives? Initially, we record them at cost. And in case there is no initial investment needed, there might not be any journal entry required. After the initial recognition, though, subsequently we remeasure the derivative to its fair value. And the fair value, remember, the fair value of the derivative, it keeps changing relative to the value of the underlying. There are pricing models that take care of those calculations as well. Whatever happens, any changes that occur to the derivative they're recorded in profit and loss, right? So if the fair value's gone up, you'll record a gain. The value went down, you'll record a loss. And we de-recognize the derivative under one of two circumstances. Either we exercise that particular option, or like whatever that is, we exercise that derivative and that needs an entry, or we allow that derivative to lapse, right? Not all of the derivatives need to be settled. You can have options, for example, that you can just allow to lapse. If they're not in the money, you don't have to do anything. But in most cases, you do have to settle. So the expiry, when the contract expires, there may be some payment to be made or to be received. Looking closer at options and warrants, an option represents a right, but not an obligation. That's an important thing. So it's asymmetric, right? So I get into an option situation, I will carry it through if it's to my benefit, but I have to do nothing if the option value has gone against me. But that's only if I have bought the options. If I wrote the options, oh my God, I could be in really, really deep sea. So options, there can be two types. You can have a call option, which is an option that gives the holder the right to buy. So if we think of stock options for a moment, a call option will allow the option holder to buy shares at a fixed price in the future. Now, why would I buy a call option instead of buying the shares? Well, my gut feel might be that these shares are going to go up in value. So rather than, I might be trying to get a whole lot of leverage out by, rather than buying only 1,000 shares for the same amount of money, maybe I can buy 50,000 options, right? So if the stock price does indeed go up, I would benefit from the increase in value. Right? Think about it. I could buy 1,000 shares for $20,000. Let's say the stock price right now is $20, and the stock price goes up to 25. There's a $5 increase in value per share times 1,000 shares owned. I will gain by $5,000. If instead I could buy call options for a $23 stock strike price, 50,000 call options for only a small insignificant amount, right? So say $5,000. If by investing $5,000, I can get 50,000 call options. Now, if the same thing happens and the stock price goes up to $25 a piece, I would have made $2 on each option. For 50,000 options, right? You can do the math. I would have made a profit of $100,000, and my initial investment would have been only 5,000. Earlier case was I had to invest $20,000, and if stock price did go up to 25, the total profit I would have made is 5,000. So options can potentially be very, very, very lucrative if it really works out. And if it doesn't, then I would have bought those 50,000 options. I would say, que sera, sera, that is life. I lose my $5,000, right? So my loss is limited to the amount that I put up. But if the upside does occur, the upside can be huge, right? So that is typically what the thinking would be of a possible investor, right? So an investor that is an optimist will buy these call options. If the investor, on the other hand, believes that a company is overpriced, right? So there may have been some people that thought all of these technology companies were really overpriced. Shopify, for example, selling for close to what, $2,000 at some point. $1,500, $1,600, I think it had gone up. If you thought, oh, well, that's rich, you could have at that time bought put options. And, you could have said if the stock price at that time was 1,600, you could have bought put options to sell Shopify for $1,500. People would look at you and say, you're out of your mind. But, well, I mean, currently Shopify is trading for what, $450, $500? You would have made a ton of money on your put option. So hedge funds typically engage in these kinds of activities, and they deal with these options, right? Usually investors stay away from writing the options. If you're writing the options, it's the opposite worldview that you're taking. If you expect that share value will go down, will go up rather, then you should be writing or selling a put option rather than buying a put option. And if you expect the share value to decrease, you will then be selling a call option rather than selling a put option. This is a little comparative from your textbook, what it is, right? What does it mean to write the option? What does it mean to buy the options? Most investors will be the ones that buy the options. They don't write the option. It is the company, the issuing company, that writes the options, or sometimes it is specialized brokerage houses that are market makers that are allowed to write these options. So people like you and I typically won't be allowed to write the option. And really, I can't go any deeper than this. It's just way outside the scope, right? It's more of a finance concept. So this is about as much I can talk about options right now. How are they valued? There are options valuation models out there, Black-Scholes, binomial, etc., whole bunch, and they take into account a whole lot of things about the volatility of the stock, the interest rates, the time to maturity, the expiry of the option, etc. Lots of things are, quite a few of these parameters are put in to generate a value for the option. But it is essentially broken down into two component pieces. There is an intrinsic value of an option, and then there is the time value. The intrinsic value is simply the difference between the fair value of the underlying. So we are talking about a stock option, the fair value of that share, and whatever the exercise price is of the option. The thing about intrinsic value is it cannot be negative, right? So the lowest it can go is 0. And then anything different would be the time value, which is calculated with reference to time to expiry, interest rates, volatility, etc. And for our purposes, in the questions, these values would be given. We just need to know what to do with the numbers. We won't have to sit and calculate fair value of the options. The forwards and futures. So a forward contract is something that you're going to learn about in advanced financial accounting. At least if you take it with me, I make it a point to teach it. I'm not sure about whether everybody understands it clearly enough. I'm trying to be funny here. But trust me, I have seen some instructors who would literally read out of their solution and then write down the answers. Ask them a question, they had no idea. Um, so this stuff can be complicated. Forward contracts, you're going to learn more about in advanced financial. It's basically a contract between two parties to exchange some commodity, right? You can have forward contracts for grains, for crude oil. In advanced financial, you'll learn about currencies, so foreign currencies, forward contracts for foreign currencies. The company is essentially trying to manage its risk exposure. And more details there. A futures contract is a similar concept. Oh, I should have written futures contract. So a futures contract is a concept that is similar to a forward contract, except that, whereas for a forward contract, you can customize it, in terms of the expiry date and what the amount should be. Futures contracts are standardized, so you can only have futures contracts, say, in multiples of $1,000, and the expiry dates have to be the specific month ends, right? So you can only get into futures for that are expiring June 30th, July 31st, August 31st, like that, right? So specific expiry dates, but they tend to be more liquid than a forward contract because you can buy and sell futures contracts on a futures exchange. And there are clearing houses that are involved, large houses. So, the risk of counterparty risk is reduced a little bit, like the risk of the other party saying, oh, I can't pay you anything is kind of limited. And the enforcement happens by way of collateral margin requirement. And if you have Netflix or if you're able to look up YouTube, I would definitely recommend watching Margin Call. It's a docu movie that they made about the financial crisis that hit North America in 07, 08, right? So Margin Call might be a good little docu movie to watch. A few quick little examples and then we'll go for a break. So really short examples, and these are questions modeled or taken from the textbook. So 16.2, 16.3, January 1st, 2020, Roper Inc. agreed to buy 3 kilograms of gold at $40,000 per kilogram from Golden Corp on April 1st, 2020. So notice, the date at which Roper is agreeing to buy is April 1st. That's the expiry date. Specific amount is 3 kilograms of gold, right? That's the quantity that Roper Inc. is looking to buy. And the price, the fixed price that Roper Inc. is looking to buy it as 40,000. So this is an example of a forward contract. Now, the value of the forward contract will depend on the spot price of gold. So as the spot price of gold fluctuates, the value of this forward contract will also go up or down. Roper does not intend to take delivery of the gold. So the Roper doesn't need the gold. So this is a speculative contract. If Roper, for some reason, needed the gold, right? Maybe they were making something out of the gold, then it would be a contract that is looking to hedge its risk to commodity price changes. Here, it's just a purely a speculative play. Roper doesn't want to buy the gold. They just think the price of gold will go up and they'll make some money. On the date the contract was entered into, the fair value of this forward contract was zero. And that usually is the case because you value it at the price, the reigning price at that time. So it nets out to $0 at the time you start. And the fair value of the forward contract subsequently fluctuated. And why is it fluctuating? Because the price of gold, spot price of gold is fluctuating, going up, going down. And so what happens? January 20th, the fair value of the forward contract was $450. February 6th, the fair value dropped to 125. February 28th, the fair value went up to 360. And then March 14th, the fair value was 700. And these are just random dates and numbers. On the settlement date, which is April 1st, the spot price of gold was $41,000 per kilogram. Assume that Roper complies with IFRS. So the first part asks us to record the journal entry for the date the forward contract is signed. On the date the forward contract is signed, because the fair value on that date was zero, there is no journal entry required. And that is typically the case for all forward contracts. On the date that you sign the contract, typically there is no journal entry needed if you're following what's called the net method. Now, subsequently, as the forward contract's value changes, you will need to record an increase or decrease in the value of that derivative and the accompanying gain or loss. So we're starting with $0 for the forward contract on Jan 1st. The first measurement date that this company chose was January 20th. And on that date, the fair value of the forward contract is $450. From $0, the forward contract has moved to a value of $450. We need an adjustment. We need an increase of $450. So on January 20th, the journal entry will be, you want to debit the forward contract. In your textbook, they use the term derivatives. It's up to you. Like I would say, use the term forward contract, nothing wrong with it, and credit gain, because the asset has gone up. So you're crediting, the credit would be gain. Now, some companies will use a generic term, gain or loss. If it's a credit, it's a gain. If it's a debit, it's a loss, right? So I'm using that generic gain or loss on forward contract. If it nets out to a credit, then on the income statement, the company will report gain on forward contract. If it nets out to be a debit, you will report a loss on forward contract, okay? So Jan 20th value was 450. February 6th, the value is determined to be 125. So from 450, it's gone down to 125. The adjustment needed is a credit of $325. So journal entry, credit the forward contract, debit the gain or loss for the 325. Is that okay so far? All right, then I'm not going to insult your intelligence any further. The remaining, so from 125, it goes up to 360. You're going to have an adjustment of $235. On March 14th, the value has changed to $700. So that's another debit adjustment needed of $340. So journal entries for that. And then lastly, the date of settlement is April 1st. On the date of settlement, the spot price is $41,000. Now think about, the company doesn't want to buy the gold, but let's say if it did. As per the contract, the company could buy 3 kilograms of gold at $40,000 per kilogram. It could theoretically buy the gold for $40,000 per kilogram and then sell it, because there's a ready market for bullion, right? And the price was $41,000. Buy it $40,000 per kilo, sell it for $41,000 per kilo. And it's got 3 kilograms of gold that it can deal with. The value to it, right? So if you just think of the arbitrage amount, right? I could buy it for $40,000 per kilo and then sell it right away for $41,000. Well, if it could do that, why not just make that settlement with Golden Corp? Right? Just say, you guys keep the gold, just give me the difference. Does that make sense? That was the whole point of what Roper was trying to say. Roper was betting that the gold price will be higher. So from Golden Corp's point of view, see, if Golden Corp is the gold producer, its concern would be like, what would happen if the spot price of the gold falls below 40,000? Well, then Golden Corp can come to Roper and say, well, listen, you signed the contract with us to buy the gold for 40,000. If the market price was, say, $35,000 a kilogram, then for every kilo, if Roper, because Roper doesn't need the gold, Roper would have to pay $5,000 for every kilogram of gold to Golden, because Golden can sell each kilogram for 35,000, right? From Golden's point of view, they are kind of protected. They have at least a floor for the price that they can get for the gold that they produce. From Roper's point of view, if the gold price goes above 40,000, any increase in the value, Roper can benefit from. What Roper is going to do is just call up Golden Corp and say, let's settle, right? Spot price is 41,000. We signed the contract at 40. The spread is 1,000 for 3 kilograms. That gives me $3,000. And that is the value of the forward contract on the date of settlement. 3,000 is the amount of the forward contract. All right, so our friend Roper is going to receive cash, $3,000, right? That's how much of a profit. Well, not the accounting profit. That's how much of cash that they're going to get, right? But to get there, they have to first update their forward contract. Now, their forward contract was sitting at $700. We calculated that the forward contract on April 1st is actually worth 3,000. So you want to write up your forward contract, right? Record that accounting journal entry. Okay, so debit your forward contract and credit the gain, $2,300. And now, because April 1st is the date the contract expires, there will no longer be any forward contract after April 1st. So what you do is you credit the forward contract and debit cash get from Golden Corp. That would be the other half. You can combine the entry. Your textbook solution combines the entry. I think this is cleaner. It kind of shows you the way it progressed. Why did you get the 3,000? Well, that's the difference between the contract purchase price and the spot price of gold. Our friend Roper never wanted the delivery of the gold, so it just wants to square off on the difference. So that's how much cash it's going to get. It's the forward contract was sitting at that date on its books for $700. So the difference between the cash that it's getting and the book value of the forward contract at that date is the additional gain of $2,300 that you end up recording. Does that make conceptual sense? All clear. Clear as mud. All right. Part D is basically exercise 16.3, which says assume the same facts, except that rather than having a forward contract, if it was a futures contract that trades on a futures exchange. So rather than signing this contract with a specific other counterparty, if our friend at Roper bought futures contract to buy the 3 kilograms of gold. Now, since futures contracts are traded on a futures exchange, companies that want to enter into futures contract, they are required to put in a margin deposit. So the deposit amount that they're showing here is really small, $65. I would say it should be higher, but Anyways, it's a Mickey Mouse example. So they're asking us to repeat what we just did if it was a futures contract. And what I submit to you is it's exactly the same, with the one change that since on January 1st, Roper has to pay $65 as a deposit, right? As margin is a deposit, right? With the stockbroker, it'll record, rather than having no journal entry required on Jan 1st, Roper is going to record an extra journal entry for the $65 deposit that it places. Okay, so it will record a futures contract deposit, $65. Afterwards, all its journal entries are the same as you saw for 16.2. The only change I made is, instead of using the word forward contract, I changed it to futures contract. They're all the same. The calculations are the same. April 1st, you still do the same thing. And when you're squaring off your position, you also get back your $65 deposit. So rather than receiving only $3,000 of cash, Roper will get back $3,000 plus the $65 of deposit. So that will be the difference as far as the cash amount is concerned. Okay, my dear friends, that was a very short and simple example of forward contracts, futures contracts. I would not worry a lot about the exam. These are esoteric pieces. You're going to learn a lot more about forward contracts in advanced financials. So I showed you these examples just so that you can say, okay, we've seen an example, but I do not expect or intend to examine you on this piece for next week, for your next week's midterm exam. Last example before we go for a break, exercise 16.5, it's a call option. So April 1st, 2020, PD Limited paid $175 for a call to buy 700 shares of Northern Tel at a strike price of $27 per share anytime during the next 6 months. The market price of Northern Tel shares was $27 per share on April 1st, 2020. Now, so what is PD Limited doing, right? Rather than buying 700 shares of Northern Tel for $27 and holding on, they're saying, listen, we'll just pay $175 for a call option to buy these shares at $27 for the next 6 months, over the next 6 months. Now, over the next 6 months, anything can happen. Northern Tel stock price might stay at $27 and not budge. Well, PD Limited can choose to buy the shares anytime within the next 6 months if it wants to, or if it thinks, nah, not my cup of tea, it would have just lost $175, nothing more. If the stock price of Northern Tel goes up over $27, then PD Limited would say, hey, that's a good call. I can say the stock price goes up to 30, PD Limited will be able to buy those 700 shares at $27 each, right? So that would be good from PD's point of view. Or Northern Tel stock price could fall below $27, right? Say it falls to $25. Then PD Limited would say, you know what? I don't have to buy these shares, right? I'm not forced to buy these shares, so I'll just walk away, and would have just lost the $175. So depending on what the outcome is, if the option is in the money, so for the option to be in the money, the company should be benefiting from what has happened to the price of the underlying. The underlying here is North Tel's stock. So if North Tel's stock goes over $27 stock price, our friend PD, its stock options will be in the money because it'll be gaining money there. Because basic sort of economics tells you if the stock price over the 6 months goes up to say $30, PD can easily buy these shares for $27 each and sell them immediately at $30 each. There might be a small amount for transaction costs, but the difference, right, $3 times 700 can still make a gain of $2,100. And even if you subtract the $175 cost of the options initial purchase, still going to pocket the difference, right? So that's pretty healthy. And that's essentially what's happening in this example. The market price was $27 at the time they bought the options. On June 30th, 2020, so just 3 months later, the market price for Northern Tel stock was $38 per share, and the fair value of the option was $10,000. We're asked to record the journal entry for the purchase of the call option on April 1st. On April 1st, PD paid $175. So credit cash 175 and debit call options. In your textbook solution, they use the term derivatives. It's your call. I find the word derivatives, it's such a catch-all thing. So I prefer to use the specific terminology. CPA Canada prefers that as well. And then if I keep track of the call options, on April 1st, I recorded my call options at 175. June 30th, the fair value of the option has gone up to 10,000. So that's a huge bump from 175 to 10,000. Increase is $9,825. So prepare the journal entry to recognize the change in the call options fair value at June 30th. Well, guess what? I'm going to debit my call option, 9,825, credit a gain for 9,825. Right? So that's my gain, $9,825. Feeling really proud about my call. The thing is, this is such a matter of luck. You never know which way the wind is going to blow. So this is simply accountants keeping everything into perspective. There's really, unless you're actually looking to lock in this gain, there's not much to be cheerful about. And the company incidentally tries to do the same. Prepare the journal entry that would be required if PD exercised the call option and took delivery of the shares as soon as the market opened on July 1st, 2020. Now, it doesn't quite specify what the opening market price is, right? And so again, this kind of tells you this question was written at a time when stock markets were not very volatile. In today's day and age, the price changes can be quite significant. So I'm assuming that the market price on July 1st was also $38 because there's no amount given for what the market price for the shares was on July 1st, 2020. So I'm assuming that the market price, the moment the markets opened, was also still $38. Maybe the company placed a buy order before the markets opened. Sometimes you have these orders that are in the queue that did not clear yesterday and they might have cleared anyways. Without being too esoteric there, they're buying 700 shares of Northern Tel, and the fair value is $38. The company will recognize the investment, the FPPL investment, at 700 times the fair value of $38. So 700 shares multiplied by $38. The initial recognition of these shares is at fair value, so 26,600. How much did the company actually pay? The company isn't paying $38 a share. The company had call options to buy the shares for $27 each. So the cash that the company pays is 700 times 27, which is 18,900. Now, the difference between the two, is going to be captured by our call options and any gain or loss. Now, what's my call option? My call options were sitting at 10,000. Now that I've exercised my call option, this call option account needs to be closed out. So I need to credit call options for $10,000. Right, to get rid of my call option. But now when I look at the totals, my total of credits is bigger than the total of debits. the difference ends up being recorded as a loss. Oops. $2,300 loss. And it's just an accounting number. It's just a book entry. The fact of the matter is that the company was able to buy these shares for $27 a pop when the market price was 38. So if you do the calculation in your mind, I got value of $38 per share, and I only had to pay $27 per share. So on every share, the company gained $11. There are 700 shares in total. If you multiply 700 times 11, the total amount of the gain the company experienced is $7,700, right? It had to pay an upfront cost of 175. So even after subtracting that upfront cost of 175, the net gain is 7,525. Let's check if that happened. On June 30th, we recorded a gain of 9,825. On July 1st, we're recording a loss of $2,300. So gain of 9,825, loss of 23, that's your 7,525. So really no magic there. It's just how the numbers moved over these dates. That Hardy's was derivatives. What's left for us is a discussion of stock compensation. So we're going to look at stock options, compensatory stock options, and stock appreciation rights. It is going to take us time, so I propose we take a breather, take about 10 minutes. Tonight will be a full class, might go over a few minutes. So the first thing we'll do when we come back after our break, is I'll give you a heads up about the midterm exam, what the structure will be. I will be out of the city, but I will try to still monitor my my computer in case there's any emails, etc., coming in. But most likely, because the setup will be that as an assignment. Has everybody submitted assignments using D2L in the past, like the courses that you've taken? Do you know where to find an assignment and how to submit an assignment, etc.? Everybody okay with that? Yeah. So that is pretty much what it's going to look like. I will talk a little bit about the midterm once we come back. It's 8 o'clock. Let's try to get back by no later than 10 after. All right. And I am going to pause this recording here. Companies can have different types of stock compensation plans. The more common ones are stock option plans that are available to all employees. They're called ESOPs. And the idea there is to impart or infuse a sense of loyalty towards the company. You know, if the company does well, we all benefit from it. And so let's put in our 100% and let's stay committed to the welfare of the company. For those of you that are old enough, you might remember old WestJet ads. Now, WestJet is a private company now, but there was a time when WestJet used to be a publicly listed company, and all WestJet employees had stock options, right? So they used to run those TV commercials saying, "At WestJet, we are all owners," right? So their idea was to instill a sense of pride and belonging to the company. ESOPs are available to all employees and they're not seen as compensatory. Now, when you're dealing with compensatory stock option plans, these are not available to all employees, but they're instead offered to a select bunch of employees, usually senior management. And hence, these are seen as additional compensation, right? Because these options, every option, the fact that you have a right but not an obligation, right? You can buy shares at a prefixed price but don't have to, allows individuals to wait and watch. Right? So if stock price goes up, you can benefit from any rise in the stock price. Stock price doesn't go up, well, then you're not forced to buy those shares. So that is something that is quite valuable. The ability to wait and watch. So if even if the options might not have an intrinsic value that is positive, the fact that you have the ability to wait and watch will always accord a stock option some time value. So the option premium at any point in time tends to be positive. So we will be looking at compensatory stock option plans examples. Sometimes companies might do direct stock awards. That's just the company simply issues a whole bunch of shares to individuals. Those are dealt with when they occur. We won't do any examples of that. There are also performance type plans. Companies like General Electric uses it where they set up certain targets and they say if you meet the targets, we will issue you a certain number of stocks as a goodwill gesture, or we'll pay you a bonus equivalent to the increase in value, the stock price above any certain threshold. So those are performance type plans that again are idiosyncratic, depend on the circumstances, and we're not able to do any examples of those. But companies do often use what's called stock appreciation rights, and we will look at examples of that. Stock appreciation rights are discussed in an appendix to Chapter 16 in the textbook, but CPA Canada does have extensive coverage of them in the IF2 Cloud course, which is the corresponding course with CPA Canada. And I know that amongst you, not everybody would want to become a CPA, but many of you have that intention. So that is why I'm making sure that our coverage is in line with CPA's expectations as well. So moving on, stock options, this chart here is taken from your textbook and kind of gives you a really good overview of the various types of options that might be in play, options that are either issued by the company or are issued by other financial institutions. Some of these stock options may be issued or traded on stock exchanges, but many a times the options issued by the company are not traded on a stock exchange because they're not transferable to other parties. Now, when dealing with stock options, we have to keep in mind there are a few important dates that we have to be aware of. The date at which the options are granted or awarded, so that's called the grant date or the award date. And that's the date that we actually measure the value of the stock option, but we don't really record anything at that. Then usually with the stock option, because you want to make sure that the employees don't leave in a jiffy, there's usually a vesting period, right? So between the date that the options are awarded and the time when the employees are actually able to exercise those options, that's called the vesting period, right? So the date after which employees are able to use the options or exercise the options, that's called the vesting date. The compensation expense relating to the stock options gets recorded over the vesting period. The vesting period can be sometimes many years, can be 2 years. And so basically what you got to do is take that compensation expense and spread it out, right? So just record it over the vesting period. After the vesting period is done, there's no further compensation expense recorded, but employees are able to exercise their stock options. Now, what happens when an employee exercises the stock option? An option is essentially the right to buy the shares of the company at a fixed price. So the employees will pay the company cash to buy the shares. If the employees exercise the option, the company will receive cash and the company has to issue common shares. So if there is exercise on the date of exercise, some transaction has to be recorded because we have to record the issuance of common shares. We have to record the receipt of cash. and a certain portion is taken out of contributed surplus and moved into common shares. Sometimes the options are not in the money, or the employees don't want to, because the employee has to pay cash, right? The employees might say, even though I have the option, I just can't, I just don't have the cash, so I don't want to exercise my option, and they just let them lapse. So these options don't remain in effect till forever. So at the expiry date, if there's any options that weren't exercised by that time, they lapse, and any remaining contributed surplus then gets transferred out into expired stock options, contributed surplus. Now, I mentioned that on the grant date, we measure the value of the stock option. And that is done using some options pricing models. These are fairly complex models beyond the scope of our course, but you should be aware of the more commonly used option models. There's the Black-Scholes model, and there's another model that's called the binomial model. Most companies will use one of the two. So on the award date, when we look specifically at the accounting for stock options, on the date these stock options are awarded or granted, we determine what the fair value of the options is, but there's no journal entry recorded yet. We determine how much the options are worth, but don't record any journal entry yet. When's the first journal entry recorded? The first financial reporting date after the date of grant. Okay. And then onwards, over the entire vesting period, we record compensation expense. Now, the compensation expense needs to be recorded at the expected amount of options that are going to vest, not the total number that are granted, because if employees don't stay with the company before the options vest, then they forfeit, right? So if I was an employee that got 1,000 options, but I can only exercise those options if I stay with the company for, say, the 2-year vesting period. If I find myself a better job and I say, chuck it, I'm not going to stay, I will forfeit my options. So the 1,000 options that I was granted will no longer be in effect. So the standards, IFRS standards, require companies to calculate or estimate how many options will actually vest. And they have to take into account actual forfeiture rates resulting from departure of employees, as well as expected forfeitures resulting from other employees leaving before the options vest. Okay, so that is important. The textbook examples are a little wishy-washy, so that's why I've made some adjustments to the examples that I'm going to show you. But we need to essentially record the compensation expense over the vesting period. And there's some proration needed. If the vesting period is 2 years, for the first year, I would only record half of the resulting compensation, and then the next year, whatever the other half is. Once the options are vested, there's no more need to record compensation expense. But then if they are exercised, we have to record that fact. And keep in mind, if the options are exercised, the employee must pay the company cash, the company must issue common shares, and a portion of the contributed surplus that was initially recorded at the time of compensation expense will need to be moved into the common shares account. All right, so the journal entry is as per the screen: debit cash, debit contributed surplus, and credit. If the options are not exercised and they're allowed to lapse, well, then the contributed surplus amount gets moved out of contributed surplus stock options into another account called contributed surplus relating to expired stock options. That contributed surplus relating to expired stock options will stay in shareholders' equity unless it is used up to pay out a liquidating dividend. So without further ado, taking a look at an example, we're looking at exercise 1619. I have amended the question a wee bit. It's adapted. And the question is about Waldorf Corporation that issued 1,000 share options to each of its 40 key executives. So total number of share options granted, 1,000 for each employee times 40 employees, is a total of 40,000 options. Each option allows the executive to purchase one share of Waldorf's common share at a price of $30. So strike price is $30. Strike price, exercise price, these are just terms used for how much the employee has to pay to the company to buy each share. $30 is how much the employee has to pay to the company to be issued one common share. Now, again, the employee will only exercise the stock option if it's in his or her self-interest to do so, and they would only want to exercise the option if the actual market price of the shares is more than the $30 start price. If it's not, the options are said to not be in the money, and the employee would say, why would I pay $30? Say, if the stock price was $25 per share, the employee would have to be an idiot to pay $30 to the company, and they could easily buy the shares for $25 on the market. If the market price is more than $30, then it makes sense, right? The employee, let's say if the market price is $35, the employee would say, oh yeah, I could buy the shares for $30. And if this is a really good investment, I'll keep the shares. If not, I'll just sell the shares and pocket the difference, right? So that's typically how human behavior works. So for us here, the grant date is Jan 1st, 2020, okay? So the date the options are granted is January 1st of 2020. There will be a vesting date and there will be an expiry date. So these options are exercisable within a 2-year period beginning January 1st of 2022. So our vesting date is starting Jan 1st, 2022. So our vesting period basically ends on December 31st, 2021. From Jan 1st, 2020 up to December 31st, 2021, the 2-year period is what we are going to use to record the compensation expense. And then after Jan 1st, 2022, the employees can exercise these options within a 2-year period. So 2-year period starting on Jan 1st, 2022 is going to end on, expiry date for us will be end of 2023, December 31st, 2023, right? All of 2022, all of 2023. So expiry date is December 31st, 2023. So long as the grantee is still employed by the company at the time of exercise. Of course, you can't leave the company and say, oh, I want to exercise my stock option. You've got to still be an employee of the company to exercise the option. So you leave the company, you forfeit your stock option. All right. On the grant date, which is Jan 1st, 2020, Waldorf shares were trading at $25 per share. So look at the strike price. Strike price is $30. The market price at the date the stock options were granted was $25. Now, certainly, if you were the employee being granted the stock options at that time, A, you can't exercise it yet because the vesting period is not over. But even if you could exercise the options right then, you would be daft, right? Why would you do it, right? The market price is $25. What sense does it make for you to pay $30 to the company to buy each share? You'd say, I would wait. Now that's the idea. Why is the company doing this? The company's saying, hey, listen, if you're the key executives, if you guys really work hard, if you put in all effort, then, if you try to make the company more profitable, right? You try to improve the future prospects of this company, then the value, the market price of the shares will go up, right? Assuming that markets are reasonably efficient, the market price will go up. And if the market price goes up, then not only do the rest of the shareholders benefit, you guys too will benefit from the higher stock price, right? If over time you can drive up the stock price of the company to $40 per share, well then each of your options will be in the money, right? You can buy each you can exercise each option, buy shares for $30, and even if you don't want to keep those shares, you can sell them for $40 and pocket the difference, right? You will benefit if you stay with the company for the long run and you work hard to achieve the common purpose of better profitability, better future prospects. That's kind of the theoretical underpinning of why companies will use compensatory stock options. So at the time these options were granted, they were not in the money, but using an options pricing model, the company determined the total compensation to be $1,680,000. So the total value of these options that the company issued is $1,680,000. Remember, there's a total of 40,000 options. Total value in dollars is $1,680,000. You divide the $1,680,000 by 40,000, you get a value per option of 42 bucks. Right? Each option had a fair value on the date they were granted of $42. All right, now in terms of accounting, on the date the options are granted, there's no journal entry recorded. Jan 1st, 2020, nothing. After this point, we have a total of 1,680,000 that we determined on the date. But remember, that is for 40,000 options. IFRS says use the estimated amount of options that will actually vest. So we have to make adjustments for cancellations of the options because employees left the company, as well as estimated forfeitures due to expected departures of people, because people leave, right? People are mobile. Maybe the other company offers a sweeter deal, and the employee leaves. And if the employee leaves, they're going to give up on the number of options that they have. So we, in the original question, they didn't take into account these departures and so on. And that's the critical piece. Like if you don't include that, then it's a Mickey Mouse question. So I added all that information here. So one employee left in 2020. Out of the 40 executives that were granted these options, one of them left in 2020. And as at December 31st, 2020, which is the first reporting date after the options were granted, Waldorf estimated 5 more executives to leave before the vesting date. So one person's already left, and the company expects that 5 more will leave. So originally we had 40, right? We had 40 executives. 40 key executives jumping on the bed, one fell down, and 5, well, anyways, you get the picture. The company expects at the end of 2020, only 34 employees will stay till the end, right? So our calculation needs to be based on the 34 employees that are expected to remain with the company. So we'll say, all right, each employee is going to get 1,000 options. You have 34 employees, 34 times 1,000, total of 34,000 options will actually get exercised eventually, or will vest eventually. The stock price, the value rather, not stock price, the value of each option is $42. And since the vesting period is 2 years, 1 out of 2 years is over, so half that amount has to be recorded. So I'm going to show you the math here. We started with $0, right? Our contributed surplus for the stock options was $0 on Jan 1st, 2020, because there was no journal entry. But now if you look at it, out of 40 employees, 1 is gone, 5 more are expected to leave. So we expect 34 will stay for the entire vesting period. Each employee's got 1,000 options. Each option has a value of $42, and half of the vesting period is over. So 34 times 1,000 times $42 times half the period. Math, 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 math. December 31st, 2020, the amount that you want for the contributed surplus is 714,000. So because we started with nothing, we need to record a compensation expense of 714,000. So debit compensation expense, credit the contributed surplus for $714,000. That's December 31st. The compensation expense will be deducted on the income statement, and the contributed surplus is part of shareholders' equity. Okay, does this make sense? All right. Next year, 3 more executives departed in 2021. This is made it a bit tricky. So, we were expecting that 5 more people will leave, but only 3 left. So what is the actual number that did get vested? It's not 34 minus 3. So I've seen people do that. Look, we were expecting that 5 more employees will leave before the vesting date, but only 3 left. So how many actually stayed on after the vesting?
36.
36. So this is like, you got to still kind of go back to the basics and go, okay, we began with 40, right? So 40 key executives jumping on the bed, right? 1 fell down in the first year, 3 more fell down in the second year. There's 36 that are still jumping on the bed, right? So 36 vested, 1,000 options each, $42 each, and then what? Like the vesting period is done, so we don't have to do any further fractional calculation. So 36 employees times 1,000 times $42, that gives us what we need in our contributed surplus account is 1,500,000. Well, we've already got 714. So how much more do we need to put in? The difference, and that's got to be our compensation expense. That's our compensation expense, me hearties, $798,000. And that's what you record on December 31st, 2020. Right, so the total of 4 employees that departed the company, the compensation, the stock options relating to those 4 employees are also gone. So we only have 36,000 options that did get vested, and the dollar amount relating to those 36,000 options is $1,512,000. So even though initially the company had valued the stock options to be worth $1,680,000, we don't end up recording total compensation expense for that. The compensation expense reflects the ground reality of how many people stay with the company. Okay. All right, then what happened afterwards? So once the vesting date's over, then it's up to the employees to exercise their options. So on May 1st of 2022, 12,000 options were exercised when the market price of Waldorf shares was $34 per share. Now, this market price, $34 per share, doesn't really matter to us because when these options are exercised, the employees are going to pay the company $30 per share. Right? That's the amount of cash the company is going to get. And the company will move the proportionate amount from contributed surplus into common. So when these stock options are exercised, there's going to be 3 things happening. The company is going to debit cash for the amount of cash received. The company is going to credit common shares because they're issuing common shares. And the company is going to move a part of the contributed surplus stock options into the common shares. So your journal entry is going to look like this: debit cash, debit the contributed surplus stock options, and credit common shares. The question is, how much? How many dollars? So it's 12,000 options are exercised. So 12,000 multiplied by $30 each. That's how much each employee is going to pay to the company to buy the shares. So 12,000 times $30 is $360,000. Now, each stock option had a value of $42. So since 12,000 options are being exercised, $42 times 12,000 will be moved out from contributed surplus. That's 504,000. The total amount, so think of this $42 contributed surplus as being kind of the down payment that these employees have put towards buying the shares through their quote unquote sweat and labor, right? Remember, these stock options are seen as compensatory. So these people really work their butts off, and that's the value of their sweat equity here. 42 bucks a pop, 12,000 options, works out to $504,000. The combined amount is credited to common shares. 360,000 cash plus $504,000 from contributed surplus. We credit common shares for $864,000. Now, what's the impact on the contributed surplus? Well, we debit the contributed surplus for $504,000, and that makes this contributed surplus balance go down to $1,008,000. Now, the question tells us that these remaining options lapsed in 2023. For whatever reason, these employees, these executives, they stayed very greedy. They thought it'll go up, the value will go up more, and it didn't go up, and the options were allowed to lapse. So we still had $1,008,000 sitting in the contributed surplus account. Once these options are lapsed, there's no more need for the contributed surplus stock option. What you do is you got to wrap it up, right? You got to wrap up this account, so close it out by debiting contributed surplus, and instead credit contributed surplus expired stock options. See how innovative we are with naming, right? So we had contributed surplus for stock options. Stock options expired, move the amount into contributed surplus expired stock options. So the money essentially stays in, or the value stays in. Hello, everyone. This is Harjinder, and as promised, I am presenting in this recording material covering stock appreciation rights. This was a topic that we were not able to get through in our class on Thursday evening. And a reminder that this material is also examinable for our upcoming midterm exam. So stock appreciation rights, it's an alternative. This is an alternative to the use of stock options, compensatory stock options. And how it works is that employees that are given the stock appreciation rights, so stock appreciation rights have to be granted, just like stock options are. But unlike stock options, if an employee is given a stock appreciation rights, he or she does not have to buy the company's shares, right? So stock options require the employees to buy the company's shares at a fixed price. And the only reason the employee would want to do that is if he or she is able to make money off of that transaction, i.e., they would only exercise their stock option if the current market price of the company's shares exceeds their strike price. Now, a drawback of a stock option, of course, is that the employee has to shell out cash, right? So they have to pay cash to the company to buy the shares at their, the agreed upon strike price. An improvement on that is a stock appreciation right, in which what happens is that the company can specify a target price, right? So that would somehow be analogous to the strike price for a stock option, but the employee doesn't have to buy the shares. So what the employee can do is, if the company's stock price goes above the target price, then the employee can exercise his or her stock appreciation right and receive either cash or request to be issued common shares. So that is what is meant by the first bullet on the screen. The stock appreciation rights may be cash settled or equity settled. Cash settled means that the employee would ask for to be paid cash, the cash amount for the excess of the current stock price over the target price. And if the stock appreciation right is equity settled, then he or she will receive common shares equal to the difference. Now, in case SARs are cash settled, there is a slight distinction between how IFRS moves and how ASPE goes with it. Under IFRS, we use fair value of the SARs to measure the SARs liability, whereas under ASPE, we use intrinsic value. And intrinsic value for the SARs would be the excess of the current market price of the company's shares over the target price. Now let's take a look at the accounting for SARs. On the date that the SARs are awarded, there is no journal entry required, so we do nothing. From the award date up to the date that the SARs expire, now there might be a vesting period as well. If there is a vesting period, we would prorate the compensation expense up to the point of vesting. But even after the vesting date is gone, as long as the SARs remain in effect, the company has to record compensation expense to adjust the SARs liability to fair value. And SARs liability would exist if the SARs are cash settled. And depending on the circumstances, the company may have to increase the liability or decrease it. If we need to increase the SARs liability, we would debit compensation expense and credit the SARs liability. If it's the other way around, then you would debit SARs liability and credit the compensation expense. Now, the SARs do not remain in effect forever. They do have an expiry date. So between the vesting date and the expiry date, the employees are able to exercise their SARs. Once the employee exercises the SARs, and again, assuming that it's a cash settled SARs, the company will record the cash that is paid to the employee by crediting cash and reduce the SARs liability by debiting it. Now, keep in mind that depending on the amount paid out, the SARs liability could temporarily change sign, right? Liabilities are supposed credits, but in case the cash payment exceeds the current amount in the SARs liability account, we may end up with a temporary debit balance to the SARs liability. At the reporting date, the company will have to record compensation expense to bring the SARs liability to whatever amount is needed or determined to be the required balance at that date. Once the SARs do expire, though, the SARs liability is removed from the books. So we debit the liability, and that is a typo in there. We don't credit cash, we would credit compensation. So I'm going to walk us through an example. This is adapted from the textbook question exercise 16-25, but I've made considerable changes to the example, and I have adapted it to show you both the IFRS approach and the ASPE approach. So, okay, let's take a look at the example, exercise 16-25. I've considerably made changes to this question from what the textbook question is, so please pay careful attention here. So the facts provided are that at the end of the fiscal year, December 31st, 2020, Javan Limited issued 200,000 share appreciation rights to its officers that entitled them to receive cash for the difference between the fair value of its shares and a pre-established price of $12. So $12 is the target price. Any increase in the stock price over and above $12, the employees can can get a payout, a cash payout for every stock appreciation right that has been issued. The fair value of the shares and that of the SARs using an options pricing model were as follows. We have given some numbers dated December 31st, 2021, 22, all the way till 25. And we are also given the number of SARs outstanding. Now notice that the original number of SARs issued had been 200,000. So we're told that the number of SARs outstanding in the column here reflects any forfeitures due to officers leaving the company before the vesting date. So if any employee leaves before the SARs have vested, they give up their claim to the stock appreciation right, or from any exercise after the vesting date. So vesting date, if we do the math, um, would have been, okay, the required service period is 4 years. If you start from December 31st, 2020, year one will be 2021, year two is 22, 23, 24. So the SARs will vest on or after December 31st, 2024. So employees can request a payout after December 31st, 2024. So effectively starting Jan 1st, 2025. And the exercise period is 2 years from the date of the service period. So 2 years from the date of the service period would be basically December 31st, 2026. The company recognizes the SARs in its financial statements, assume that Javan follows IFRS. Okay. We've been asked to prepare a schedule that shows the amount of compensation expense that is allocable to each year that is affected by the share appreciation right plan. I find it a little easier to do if you just make a T account rather than making a schedule, the type of which is shown in your textbook solution. I find that it's a lot easier to keep track of it using a T account. So keep in mind that if you're following IFRS, the SARS liability is calculated using the fair value of the SAR. So this column here, the fair value per SAR, right? This column, fair value per SAR, stock appreciation, right, is what will be relevant to us. So we need this and the number of SARs outstanding, and keep in mind that during the vesting period, we have to prorate for the length of time that has expired since the date of award, which is December 31st, 2020, and the date the SARS vest, which is December 31st, 2024, also known as service period. When the SARs are initially granted, the SARS liability would be recorded at $0. Nothing is recorded because no service has yet been provided by the employees to whom the SARs have been awarded. Fast forward 1 year, and on December 31st, 2021, each SAR has been valued at $6.25, and the number of SARs outstanding is 195,000. So as of December 31st, 2021, we need a liability balance to be equal to $6.25 times 195,000 SARs outstanding, adjusted for the portion of the service period that has expired. And keep in mind, the total service period was 4 years. And out of the 4 years, only 1 year has passed. So 1 out of 4. Prorate 1/4. That will give us an amount equaling 195,000 times 6.25 times 1/4, $304,688. So that, since we began with $0 in the SARS liability, will equal the compensation expense to be recorded for the year 2021. So just to show you the journal entries then, on December 31st, 2020, there was no journal entry recorded because none was needed. But on December 31st, 2021, we would record compensation expense debit and credit the SARS liability for $304,688. Go forward 1 more year. And what has happened is that the fair value per SAR has gone down to $1 each. And the number of SARs outstanding is now 190,000. So some other employee or employees must have also left. So now, how much is the balance that we need on December 31st, 2022? Okay, so it's $1 per SAR times 190,000 SARs and prorated for now 2 years out of 4 for the service period that has expired. So that is going to give us $95,000. So our SARS liability needs to be decreased to $95,000 from 304,000 and change down to 95,000. That can only happen if we debit the SARS liability for the difference. And we're going to debit the SARS liability for 209,688. So that's going to represent for us a recovery of compensation expense. So our journal entry is just going to be flipped here, debit the source liability and credit the compensation expense for 209,688. And then you just keep going through the process. Year 3, the fair value per SAR is $10.25. There's 182,000 SARs remaining. So $10.25 times 182,000 SARs, prorated for 3 years out of 4 that have now expired. And that works out to an amount of 1,399,125. So we've got to increase our SARS liability from the 95,000 to this 1,399,000. And that's going to call for a credit to the SARS liability for the 1,304,125 and debit compensation expense. Fourth year, December 31st, 2024, each SARS fair value is being measured at $9.50. There's 175,000 SARs outstanding, and the entire service period is now over. So there's no further need to prorate. So 175,000 SARs times $9.50 works out to 1,662,500. So again, we increase the SARS liability by 263,375, and that represents an expense for us. So we want to debit compensation expense, credit the SARS liability for 263. Now, what happens after this is we're told that on March 31st, 2025, so part C, March 31st, 2025, 150,000 SARs are exercised. All right. And the fair value of the shares on that date is $25. The fair value per share on March 31st, 2025. Now, notice that the March 31st, 2025 information is not given in this table, so this is separate. So for us, what matters is the fact that employees are supposed to receive the difference between the fair value of the shares on the date they exercise their SARs and the pre-established price of $12. So if on March 31st, 2025, the fair value of each share was $25, the employees are going to get $25 minus $12, so $13 each for the SARs. So if we do the math, it's going to work out to credit cash $1,950,000. That's how much cash the company will have to pay to the employees for the 150,000 SARs exercised. And that's going to result in a reduction to the SARS liability by 1,950,000. You're going to debit SARS liability by 1,950,000. Now notice we didn't have that much balance on December 31st, 2024. So this is going to temporarily result in our SARS liability having a debit balance, right? That's going to be dealt with at the end of the year. So come end of the year, 2025, and notice that we had 175,000 SARs at the end of 2024, 150,000 got exercised. So that number then has dwindled down to 25,000. And the fair value of each SAR has gone down to 75 cents. So as of December 31st, 2025, the SARS liability balance will be calculated by multiplying the number of SARs by the fair value per SAR, which is 75 cents. And since the SARs are all vested, there is no need to prorate or anything. So we want an ending balance in the SARS liability to be 18,750. Now, this is where you'll have to kind of pull out your accounting knowledge and say, okay, so we had previously a balance of 1,662,500. We paid out 1,950,000 for the exercise of the SARs on March 31st, 2021, and we want the ending balance to be 18,750. The only way this can happen is if we record a compensation expense equal to 18,750 plus 1,950,000 minus the beginning balance of 1,665,500. And that gives us 306,250. We got to record compensation expense on December 31st, 2025 for 306,250. The SARs, the remaining SARs, we are told in Part D, expired on December 31st. So the employees never got to exercise them. And the reason for that would be that the fair value per share must have stayed below the target of 12. That happens, it's unfortunate. Okay. So December 31st, 2026, essentially, we want to now get rid of the balance in the SARS liability of $18,000. And the way to do that is to debit the SARS liability and credit compensation expense for that amount. So this is what you do under IFRS. You measure the SARS liability. The value of SARS is taken on the basis of fair value per SAR. And the fair value is established using some options price model. Now, IFRS differs from ASPE. Okay, ASPE, if Javan was following ASPE, the SARS liability, the accounting would not have been different, but the SARS liabilities calculation will not use the fair value per SAR, but rather will use the intrinsic value. Now, intrinsic value, right? Intrinsic value per SAR under ASPE is calculated as the difference between the fair value per share minus the target price or the threshold price, right? So over here, what's the terminology they use? Established price, pre-established price. The pre-established price is $12. Keep in mind, if fair value per share is less than the pre-established price, then intrinsic value is 0. Okay, so intrinsic value cannot be negative. Okay, if the fair value per share happens to be less than $12, the SARS liability would be set at $0. If the fair value per share is more than the pre-established price, then the difference is what you would take into account to calculate your liability. So if we were to redo what we did for IFRS, assuming Javan followed ASPE, then we're going to be looking at the fair value per share, right? And keep in mind, the established price is $12. So for the first year end, fair value per share is $15. Because $15 is more than the pre-established price of $12, we will multiply the number of SARs outstanding. So starting December 31st, 2020 with $0. Then for the first year end, so take the 195,000 SARs outstanding multiplied by the difference between the fair value per share and the strike price of $12. So 15 minus 12, $3 per SAR, and then times that by 1/4. Okay, times that by 1/4, and that works out to $146,250. Right? So you want $146,250 to be the SARS liability at the end of the first year. And that's going to call for an expense, a SARS expense of $146,250 for the first year. For the next year, if you look at what happens in the next year, December 31st, 2022, the fair value per share is $11. And because $11 is less than the pre-established price of $12, the SARS liability will be measured at $0. Okay, so because we have the number of the fair value per share being less, we're going to take the SARS 190,000, right, outstanding, times the difference. Now, you just have to keep in mind when you're doing this math, 11 minus 12 is going to give you -1. So please make sure that you do not put that negative amount. The SARS liability cannot be negative. So make sure that is taken care of. Do not put in a negative value for the SARS liability. It can be a temporary outcome, as we saw, if the payment exceeds how much of a SARS liability the company has, but the company will never, under ASPE or even under IFRS, consciously record the SARS liability as a negative amount. Okay, so your SARS liability is 0 at December 31st, 2022, and that means there's a recovery in the amount of 146.50. So what we do is debit the SARS liability, credit compensation expense, 146. For year 3, the fair value per share is $21, which is more than the pre-established price of 12. So 21 minus 12, each SAR will have a value of $9. And if we take 182,000 SARS, multiply that, right? So we have to adjust for the employees that have left. So 182,000 times 21 minus 12 times 3/4. That gives us a dollar value of 1,228,500 rather. And since we began with a $0 value, the entire excess is the compensation expense for the year 2023. So debit compensation expense, credit the SARS liability, 1,228,500. And then finally, year 4, the fair value per share is $19. The pre-established price was 12. So each SAR is worth $7. And we have 175,000 SARs outstanding. So 175,000 times the difference between the strike price and the fair value and the strike price times 1/4. And that works out to 175,000 times 7, which is $1,225,000. Of course, if we take a look here, our SARS liability originally was bigger, so we end up with a recovery of, that's not right, $3,500, right? So we end up with a recovery of $3,500. And that for that, we need to debit the SARS liability and credit compensation expense for $3,500. All right. Now, come March 31st, 150,000 SARs were exercised, and the fair value on that date is $25. Now, of course, that would mean debiting 150,000 SARs times $13, as I explained. So that's going to reduce our SARs liability, and we will have to pay out cash totaling $1,950,000. And after this, if we look at December 31st, 2025, the fair value per share is $10. And because the pre-established price is 12, the fair value being less, we know the SARS liability cannot have a negative, right? It cannot have a negative balance. So that means we will have to set that as 0. But we still have to make sure that the account balances out. So over here, if you take a look, we had started the year with $1,225,000. We have debited the SARS liability by $1,950,000. We still have to record an expense to make this all work out. And that expense will be, okay, we want the balance in the liability to be $0. But because we have paid out $1,950,000 as opposed to a beginning balance of just $1,225,000, we need to credit the SARS liability to close it out to $0, 725,000, and debit compensation expense. So that'll be $725,000. And on December 31st, 2026, the remaining 25,000 SARs expired. So upon expiry, we are supposed to close out the liability. The thing is that the liability already has a $0 balance, so there's nothing to close. So as such, on December 31st, 2026, under ASPE, we wouldn't need any journal entry. Would be no journal entry required because there is no balance in the SARS liability. So that, my friends, is the example on SARS. There are a couple of decent questions in the textbook for you to practice from, and I would encourage you to do so. As far as the midterm exam is concerned, if you are comfortable with what we have covered in this particular example, you should do just fine. So all the best of my wishes, and I wish you all the luck for the midterm exam. Thank you very much for watching this video. Bye.